The global financial system ignored warnings about Jeffrey Epstein's $1.1 billion fortune for nearly 2 decades. It wasn't just a technical failure, it was an institutional silence coordinated for about a decade and a half. Even with suspicious activity alerts issued by banking giants, capital continued to flow freely. The network of influence wasn't just social, it was sustained by an extremely opaque financial infrastructure. Today, the new Epstein Files reveal how this billion-dollar empire remained invisible to regulators. Large institutions and regulators allowed the maintenance of an invisible billion-dollar empire for 17 years. When I first read that number, 17 years, I remember stopping for a moment. Numbers that large are easy to read on a page, yet imagining a system quietly operating that long is something else entirely. Why wasn't this flow stopped much earlier by the competent authorities? Because the structure was designed to operate in the gray zone between legality and the tax haven. The use of shell companies and private asset managers in the Caribbean created an efficient smokescreen. The entity Liquid Funding Ltd wasn't just a name on a cold piece of paper, it functioned as a transmission belt for extremely high-risk capital. The goal was to completely disconnect the origin of the money from its final destination. Reading that part made me think of something oddly simple. When I was younger and tried to understand where money actually came from in big companies, it always felt like following wires inside a wall. You know electricity is flowing, but you never see the path. The use of derivatives and complex notes made tracking difficult for common supervisory bodies. While the average investor faced strict rules, this capital navigated without global barriers. Ray Dalio has repeatedly argued that financial systems become fragile when complexity grows faster than transparency. In his view, hidden leverage is one of the most dangerous forces in global markets. The main operational base was located in an isolated territory in the Caribbean. There, bank secrecy laws were much stronger than traditional federal oversight. The Southern Trust Company served as the private vault for hard-to-value assets. This jurisdiction allowed billion-dollar transactions to occur off the Fed's radar. It was in this scenario that the monitoring of thousands of transactions was lost for years. Money circulated among heavyweight names, billionaires, and the largest financial institutions on the planet. When the compliance sector issued a warning, it got lost in intentional bureaucratic labyrinths. In the world of big investments, compliance doesn't always mean real vigilance or asset blocking. Investors like Warren Buffett have long warned about this kind of opacity. As he once put it, risk often comes from not knowing what you're doing, especially when the structure of an investment is intentionally hard to understand. Investigations connected to these financial activities began attracting federal attention in the early 2000s, a timeline referenced in reporting by the Wall Street Journal. The total financial volume monitored surpassed the mark of $1.1 billion in transfers. In total, over 4,700 individual high-value financial movements were traced. This represents an impressive average of about $234,000 per transaction carried out. Numbers like that always sound abstract at first. I usually need to pause and translate them mentally into something real, because otherwise the scale simply stops making sense. Institutions like JPMorgan Chase and Deutsche Bank generated formal suspicious activity reports according to internal banking documents later reported by the New York Times. Compliance analysts issued the alerts, strictly following technical protocol. The problem is that the system is designed so that the alert doesn't interrupt profit immediately. The suspicious activity reports became just dead files gathering dust at the Treasury. This raises the question, what's the point of monitoring if the final decision is merely political? Despite this data remained hidden from the public and other regulators for years. It took the rigorous use of freedom of information laws for the world to see these real numbers. The opening of the files revealed a massive digital archive with over 20,000 emails and messages. The communications show direct interactions with the top of the global power pyramid in various sectors. Bill Clinton appears in communications records dating from his post-presidential period. Donald Trump is mentioned in documents detailing interactions and contacts in specific periods. Court proceedings later described Ghislaine Maxwell as a key organizer of communications and contacts within the network. Elon Musk appears in email records requesting visitation schedules in the early part of the last decade. Bill Gates is cited in email drafts about elite consulting and philanthropy projects. Sultan bin Sulayem, leader of a logistics giant, appears in records of international communications. Miroslav Lajcak resigned from his advisory position after the disclosure of his presence in the records. Peter Attia has thousands of mentions in electronic communications over a 3-year period. Steve Tisch recorded interactions about investments and philanthropic activities with the network. The messages show how access to privileged information was used as a bargaining chip. It wasn't just about friendship, but a high-level social engineering for the elites. The volume of 20,000 documents is a testament to how influence was precisely documented. Each email was a piece on a chessboard involving the banking sector and politics. There were formal requests for visits, detailed schedules, and logistics for recurring private meetings. The volume of documents points to a contact network rooted in multiple governmental spheres. Much of this information remained out of public view for years, until investigative reporting by the Miami Herald helped reignite scrutiny of the case in 2018. Forensic analysis of these documents reveals a clear pattern of strategic information manipulation. Control wasn't just financial, but based on the accumulation of social capital and shared secrets. Evidence suggests communications were used to maintain dominance over political power networks. Whistleblowing reached federal agencies well before critical electoral periods at the end of the decade. However, a large part of this information was filed away under the convenient label of unverified. Task forces dedicated to serious crimes received details about high-profile global assets and individuals. Records show that the strategic resolution of the case was debated behind the scenes a few days before the end. The network surrounding the financier collapsed after his arrest in July 2019, an event widely documented during the prosecution of Jeffrey Epstein. The death in federal custody in 2019 did not, in any way, end the investigation of the assets. On the contrary, it paved the way for new transparency laws to come into effect. For those investing in the high-ticket market, the lesson here is about the systemic risk of financial opacity. Assets that seem solid may be anchored in networks of profound legal and ethical instability. The financial world has seen this pattern before. During the Enron scandal in 2001, complex off-balance sheet structures hid massive risks until the entire system suddenly collapsed. When you invest in funds with opaque structures, you directly inherit their legal risk. The market learned that hard-to-sell assets hide risks that go far beyond financial loss. The same dynamic appeared during the 2008 global financial crisis, when supposedly sophisticated mortgage securities turned out to be far more fragile than investors believed. The real volatility here wasn't the asset's price, but the integrity of the institutional support network. Integrity analysis today is as fundamental as analyzing a balance sheet. The high-level market demands that you know exactly who is on the other side of the liquidity. New transparency laws now require the Department of Justice to release millions of unpublished pages. What once took 17 years to discover now takes seconds to be processed and go viral. What we have in hand today is just the preface to a dossier the system tried to erase for decades. Financial transparency helps, but history suggests it usually arrives only after the damage is already visible. When capital becomes invisible for nearly 20 years, the entire market becomes vulnerable to collapse. The case wasn't just an individual crime, it was a stress test that the financial system failed to mitigate. Be cautious when investing in closed structures. Where there is excessive secrecy, the risk of loss is always greater. Prepare your portfolio for an era of radical transparency and total exposure of sensitive data. Follow the next chapters of this investigation, as the flow of documents is far from over. The integrity of your assets depends on understanding who is really moving the pieces on the board. Stay focused on data clarity and avoid assets whose ultimate beneficiaries operate in the shadows. The modern financial market demands more than number analysis. It demands radical transparency analysis. This is the new standard for those seeking security and growth in a landscape of hidden global risks.